Housing to crash by 320 grand. Let's have a look. Hello everyone, Florian here and welcome to another episode of HeiseSays. Grab your stein of coffee. Let's have a look at this article from news.com.au discussing, concerning forecasts from Morgan Stanley about housing in Australia to plunge 20%. Now on the all houses cost, asking prices right now from SQM in Sydney, that works out to be about $320,000. So, not chump change. But let's have a look at this first before we celebrate or commiserate. So, Morgan Stanley forecasts Aussie house prices to plummet 20%. Now remember everyone, housing has just gone nuts. We had a huge spike recently, so we've got to keep that in mind. We'll go here to property. We'll bring up national from SQM, and I'll just full screen it so we can see. So if we have a look here, we're looking at $800,000. Now if we take 20 grand off it, how far back are we going to go there? There we go. What is it? 80, 160 grand. Let's say 200 grand to be generous. We're going, 600,000? So we're going back to 2020. Okay? If we lose 20%. Look at how high this growth has been. Look at that. That's insane. And this is all the current asking prices for all capital cities. Notice how it's kind of stalled at the moment. Interesting to keep in mind. So let's have a look. Morgan Stanley warns the housing downturn in Australia will easily be the largest in recent history. Well, I mean, we did have one just before COVID, a little baby downturn, but housing falls haven't been that memorable for the last couple of decades. With price forecasts to fall a staggering amount. Wall Street, here's the thing. If we're only going back to 2020, it's still not going to be affordable. We weren't doing videos on 2020 about housing being so affordable, were we? Wall Street bank Morgan Stanley expects the entire post-COVID housing price boom in Australia to be retraced. Now forecasting prices will fall 20% nationally peak to trough. It says the housing downturn will easily be the largest in recent history. So we're coming off the sugar highs. In a new Australian research report this week, Morgan Stanley revealed it had revised its forecast from a 15% to a 20% decline in house prices, which, according to the bank, would be the largest nominal price decline in the past 50 years. Well, here's a question. Has the insane price growth we've had, has that been phenomenal and out of norm? It doesn't feel normal that housing should go up like 20% a year. I mean, you tell me, property bros. Or have I just been looking at too much crypto, expecting it to shoot up 20% in a night? The bank said the 20% fall would be more than double the size of the previous largest house price correction, which was 10% in 2017 to 19. Yeah, from 17 to 19 over 2 years. Look at that growth we got in just 1 year. So, I mean, there you go. Look, boom. It warned it would be a comparable adjustment to what was seen during the GFC crisis in the US. House prices dropped 19% from 2007 to 2012. Yes, but there's a few little, you're going to have more people fighting for their homes here in Australia than the US. You can't do the jingle mail. You know, we can't get away from it like you can in some locations in the States. Just mail the keys back to the bank. It's your problem. So people are going to continue to fight. Although it said Australia's adjustment would come with a much larger equity buffer and be a much faster correction. So, I mean, there's going to be a lot of people, like people like me, we bought years ago. It's not going to matter. You know, okay, your mortgage is, your valuation is here. Instead of being here, is now slightly here. It's still insanely high compared to when you bought. So it depends on how long ago people bought. It's going to be people who went in recently, probably who bought into the FOMO. Maybe they believed the Reserve Bank when they said they wouldn't increase rates till 2024. They took the government incentives and maybe they stretched themselves a little far. They're the ones that may be doing it tough. And, I mean, in some ways I feel sorry for the people in that situation. I feel sorry for the people who believed the Reserve Bank. Because, I mean, okay, you're watching a YouTube channel, we talk about property, we look at the news, we know not to trust the Reserve Bank. And probably a lot of you don't trust Reserve Banks at all, and I bet a big chunk of you would love to have them abolished. But for a normie who probably doesn't have the time or isn't, that interested, just follows the headlines, just votes how they're told, and they see, oh well, yeah, rates aren't going to go up till 2024. Oh look, we'll get this government grant. Oh, property, it always goes up. They said that at the barbecue. So maybe it's a hard lesson to learn. The housing upswing over 2021 was one of the largest on record. There you go, increasing 25% from the trough in September 2020 to the peak in April 22. The report authors wrote, however, the reversal since May has been just as quick, with prices falling 4% nationally in 4 months, the fastest start to a housing downturn on record. Now, we have to keep in mind, we might start seeing some rhetoric from the media and from other sources to try and influence the political class to perhaps intervene, or am I too cynical? They say the clear swing factor for both the upswing in prices and current reversals was interest rates. The report said Sydney clearly looked the most vulnerable to price corrections, as it has the highest sales prices in the country and therefore the most sensitivity to interest rate changes. I mean, Sydney prices, let's bring them up. Now we'll look at the asking prices in Sydney from SQM. We can see here, and this is where I got the 300 grand, 1.6. So they've already come off when they were, March, April, 1.775. So lost about 100 grand already for all houses. So if they lose, say, 1.3, they'll be back to 2020 levels. So they're right. We will lose all of the sugar high from the pandemic juicing of the housing sector, but this isn't the huge fall that people have been waiting for decades. This isn't the housing bubble popping and returning to affordable levels. This isn't it going back down to where someone could comfortably afford a house with one person working. We're never going to return to that level in Australia now. The government is doing everything they can to avoid that. Look at all the childcare incentives. So long as they create incentives to get both people working in a couple, you will need both people working just to buy houses because you're competing with everyone else. So we kind of screw ourselves over that way. Melbourne has also relatively high prices, but should benefit more from a reversal in migration flows. There you go. Having seen significant international and interstate outflows during COVID, it said. Of the other cities, Brisbane was noted as exposed to big declines. Apartments are expected to be more resilient than detached houses during the downturn. What's this mean? Is all the property here in Brisbane, where I live, is it going to crash? Our insane growth? I mean, let's bring up Brizzy, guys. Beautiful city, insane property. There we go. Look at that. Hang on. Look at that. 900 grand. And Brisbane houses, a lot of them, the old Queenslanders. I've got one. They're solid. They're solid, but they're crappy. They're old. It's solid hardwood. You don't have any insulation. The insulation is the air gap between the vertical jointed timber panels on the inside and the external cladding, if you're lucky. I've got some parts of the house where there is no cavity. It's just vertical, horizontal weatherboard, but it's a 100-year-old house. But there you go, guys. So if we dropped, look at that. In 2020, houses were 640 grand, and now they're all houses over 900,000. Brisbane is nuts. It's gone crazy. And, combined 3-bedders, there you go, 700, nearly 800 grand. Oh, we're down from the peak at 800. But look at that. Look at that. That's nuts. So from about 600 to 900. Okay? So yeah, I wouldn't be surprised if Brisbane is exposed. Interest rates to keep rising. House prices are expected to continue to fall into next year as the Reserve Bank of Australia hikes the cash rate. There was a 5th consecutive rise in September, which brought the rate to 2.35%, a 7-year high. RBA Governor Philip Lowe said again, the board expects to increase interest rates further over the months ahead. The board is committed to returning inflation to the 2 to 3% range over time. It is seeking to do this while keeping the economy on an even keel, he said in a statement. The annual inflation rate hit 6.1% in June, and, well, today it's 6.8% over the year. Oh, no, 6.8% now. Expected to tip 7.75% at the end of the year. Dr. Lowe said he wouldn't be surprised if Australian house prices fall by an average of 10%. And as we've seen, we're coming off a high, guys. So it's like any investment when you buy, when it shoots right up, that's when you take profit, isn't it? If you're in it for, well, trading the markets, the cycles. So, I mean, the number of people, it's going to be the people right at the edge with their equity, interest rates going up, and they're going to struggle to meet those repayments. We'll have to see if there's some that cop it like that. Morgan Stanley said, its forecast, we're clearly much more cautious than that. National home prices fell 2.7% from their peak to August and have retraced all their early 2022 gains, according to Property Track's latest home price index. It will release its newest report this weekend. Regional areas have recorded their largest quarterly price falls in a decade, but we continue to see biggest price falls in Sydney and Melbourne, with Sydney prices now below their level a year ago and Melbourne unchanged, the August report said. All capitals are now below their peak prices, with Adelaide recording its first monthly price fall this year. There you go, Adelaide, you've joined the rest of us. However, this does not mean people will have stopped selling. Despite prices falling, market activity picked up in August ahead of the typically busy spring season. New listings nationally on realestate.com.au were 9.9% higher month-on-month in August, capping off the busiest winter for new listings in 5 years. Prop Track economist Angus Moore explained, while market conditions have changed, the fundamental drivers of demand remain strong, with unemployment very low, wages growth expected to pick up over this year, and international migration increasing. So let's have a talk. I did another video where we looked at an article from Yardney, property bull, a property bro, essentially making the argument that supply issues in housing is going to be good for investors, I'd say in the next few years, because we're going to have increased demand. Demand is going to increase, and we're seeing builders go under, left, right, and centre, so our capacity to address that demand won't be there. So there you go. There's one thing to consider, and rental yields are still doing quite well. They're still bloody high, but the problem is prices have spiked. They've spiked insanely high. Look at Brisbane, guys. So if we're coming off a sugar high, we're returning to normal. Even if we go back to pre-pandemic levels, it's not going to be affordable for the average punter. Housing's still going to be bloody expensive. You're still going to have to take a long time to save a deposit. And the risk is that people bought the sugar high, they bought the FOMO, and with rates going up to fight inflation, they're going to find themselves in trouble. So we're going to start to see people tightening their belt. Even those who are not in trouble, who I bet you who have fixed mortgages, because a lot of us, when we saw a 1 for a fixed mortgage, a lot of us jumped on that. So there'll be people who'll come off that and take a good 60, 70% increase in their potential repayments. Maybe 30% if rates come down and they get a good variable. But even they might impact, or it might limit their spending, their discretionary spending. It's going to be psychological. And then we'll start to see that manifest in the retail spending of the economy. Now, the latest data that has come out, we haven't seen that yet. So people are still doing okay. So we'll have to see. Have to look at the next few months to see if that starts to manifest. If retail spending stays the same, maybe people aren't that worried. What do you reckon, guys? I mean, do you think we'll see an even bigger fall? We've got some people predicting like a 70% fall in housing, a 50% fall in housing. I look at that. I look at the rental yields. It just doesn't make sense. I mean, awesome, great. Then forget my extension. I'll go buy something else. There you go. Anyway, guys, what do you reckon? Let me know your thoughts and opinions on this one in the comments down below. If you're a fan, check out my other channels, HeiseBim and HeiseSays International, for other content I create. And if you want to support us, there are a few ways you can, financially on YouTube or Patreon, using our referral links, buying our merch, or calling us if you need an architect. Take care, guys. Have a great day. I'll see you in the next episode of HeiseSays.